Welcome back from lunch. I hope everyone had a chair to sit in while they were eating their food. Something of a battle today. Afternoon, we are going to change subjects once again. I'm sorry for the whiplash. I wish somehow it was possible to not do that, but somehow it does seem necessary, the whiplash. So we're going to do miscellaneous tax, and then we're going to talk about tax increment financing district, which will be more of a refresher 101 on how they work than a deep dive into suggested changes. But we're going to start with miscellaneous tax and what we're imagining will come before us soon in the form of some legislation. Do you have anything for us to look?
Oh, yeah, thanks. Rebecca Samaroff, Deputy Commissioner, Tax Department. And under my name is an attachment, which is a memo summarizing kind of the high-level technical proposals that tax is interested in this year. And yeah, my understanding is that there is a bill with Ledge Council right now that has the language in it.
Thanks.
Sure. So if folks have those up, I'll just move through in order. I feel like there was rhyme and reason to the order at some point, and now it's kind of become a hodgepodge. So sorry, the whiplash might continue, but maybe it's a nice blend of like boring and interesting. So hope to give you that at least. So starting maybe more on the boring side of the spectrum, as always, we'll be proposing to conform Vermont's tax laws for the 2022 tax year to the federal income tax that was in effect in 2022. And this is yes, an annual exercise that can be exciting in some years when Congress is doing retroactive tax changes, but luckily no indication of that affecting the tax year in question. So this it's kind of a low excitement year for that provision. Please interrupt with questions along the way at any point, by the way. Our second technical proposal is correcting some appropriation language in 324041 sub A. So this goes back to 2018 when there were some changes to education fund composition. And among those changes, the equalization and reappraisal account was eliminated from the education fund and moved into the general fund. And every year the legislature has made an annual appropriation from the general fund along with that move, but there's still language referencing the ed fund hanging out in one of the statutes, and the inaccurate reference just causes confusion with our AOA finance team, our tax finance team every year. So we're proposing putting that in the right place, bringing the statute in line with the current legislative practice and that intention from 2018. Also on the little boring side. Okay, getting into some juicy stuff around meals and rooms tax. This one's kind of cool. So currently there is language. So there's meals and rooms tax, there's sales and use tax. They are both trust taxes. I know you guys got a good debrief yesterday. So there's a lot of similarities between the two. One point of difference that's been raised to the department is that for sales and use tax, there's language in statute clarifying that if a seller requests a refund from the tax department of some tax that it collected and then remitted to us, it's, the onus is on them to demonstrate that they're going to refund that tax to the customer who paid it in error. And that same responsibility is not reflected in our meals and rooms statute. So under current law, an operator may have a case for asking the tax department for a refund for a tax that they erroneously collected, but then not returning it to the customers, just keeping it, which would not be an outcome that would make sense. So we just propose aligning the meals and rooms tax statute with our existing regulations, which it is articulated there, but just mirroring the sales and use tax statute that sets that expectation for operators who are getting a refund from us. Great. Sticking with meals and rooms tax, we also would like to sync up the definitions of alcoholic beverages between Title VII, which is kind of like the DLL realm, and Title 32. The reason why this came up is because last year the definition of alcoholic beverages was amended to include ready-to-drink spirit beverages like cocktails in a can. And that change was made in Title VII where in those liquor statutes, but the same edit wasn't made in our meals and rooms tax statute. So we're kind of correct. We're proposing to not only make sure ready to drink spirit beverages are considered alcoholic beverages for the meals tax, but just have our statute just point directly to Title VII. So if any other categories of beverages are added in the future, it'll just like always be linked up. We don't need to like re-articulate each listed item in our statute. So tidy cleanup there. Great. Okay, this is like probably like the apex of excitement from these technical proposals coming up here. So, we would like to clarify the sales and use tax and meals and rooms tax treatment for alcohol that's served on the premises of a combination restaurant retailer. And I'll just preview that like this has come up recently because of the prevalence and popularity of like brewery retail combos. It's become clear that there's some like murky area of statute around a business who's both selling alcohol for on-premises consumption, like at the brewery bar, but then also, in a separate area in their retail space selling 6-packs or 12-packs of their product. Our meals and rooms tax law really only contemplates on-site sales of alcohol that are for immediate consumption. And we just want to clarify that when you're selling alcohol in a to-go grocery type manner, then the 6% sales tax should be applied. And it's only when you're selling alcohol for consumption at the establishment that the 10% alcohol tax would apply. So it's more of like the meals and rooms component versus the sales and use tax component.
What about restaurants and bars that sell to-go drink?
Okay.
And also, so I'm gonna create a scenario. That's okay.
That sounds like a fun challenge. Let's do it.
So you have an on-site distillery that also has food being served. And so, the restaurant I work at sells to-go cocktails. If you order, you order a meal and you get some to-go cocktails, go with it. They're sealed with like a plastic wrapper on the top of the
for pickup.
For pickup,
Mm-hmm.
yeah. And then it also, because it's a distillery, there's also, this is an imaginary place now. You can also buy a bottle of liquor. So how would you, or a 6-pack of ready-to-go cans? And so I don't see the way that's described right there. It looks like it's just on-site consumption, not quickly intended off-site consumption or like whatever, however.
Right.
I'm not a tax law.
Right. Yeah. You're bringing up a great new, COVID era dynamic, which is now we have this kind of like new class of not quite delivery, not quite eating in house where you go and pick it up yourself. So first I just want to say that this is a correction that we're proposing in statute, and our understanding is that everyone is doing it on the ground in the way that you would rationally assume. And that assumption was verified by DLL, who is certainly not in the business of enforcing tax law, but is like very aware of the liquor licenses that allow for these arrangements and, how it is being done on the ground. And are all, on board with this clarification. So in the situation that Chair Kornheiser described, the alcoholic beverages that are put aside for customers to pick up are taxed just like they would be if you were consuming it on premises. So that would be if you had a meal and a cocktail with a cap on it, it would be 9%, and this is not a local option tax community, charge a 9% tax on the meal, 10% tax on the beverage that you're picking up to go home with, because it's, it's kind of mirroring the on-premises consumption in those cases. And then if that same establishment, being the distillery, is selling their own bottled liquor, that would have, of course, like the state's liquor tax applied, which we don't administer at the tax department. That's a DLL tax, but then the 6% sales tax because it's more of a grocery style to go item. Yeah.
Okay, thanks.
Does that make sense?
Yeah, I just want to make sure that it makes that much sense in the statute when we look at it.
Yeah.
Drafted language.
Yeah, and I yeah, I should familiarize myself with the piece of statute that allows for the new, carry out world. But nothing in this correction would impact the fact that those carry out meals and beverages are treated in the same way under the meals and rooms tax that it would be if you were saddling up to the bar to have the same meal. So yeah, we're hoping, I should say that, yeah, the outcome of this seems really great, just clarifying what's happening on the ground, which is always a good thing. And also would just provide some clarity for our auditors who are, often they're the ones to flag some like murky statute area when, the new world bumps up against their work and, making sure everyone is following the law in the course of an audit. And we're not anticipating any revenue impact from this clarification because it's understood to be current industry practice, just making sure we have a lot of clarity in our interaction with taxpayers that have these blended spaces. Any further questions on that one? As thrilling as I promised.
More scenarios.
Yeah, more scenarios. Let's go. Okay, well, if that was the apex, then I'll let you draw your own conclusions about the next one. We are proposing to remove some obsolete statute that refers to some an old PBR system that is no longer there, and it's actually refers to a fee that we would charge municipalities for using that system. And I'm not even sure we ever, when the system was active, we're charging municipalities that fee. So just a lot of layers of obsolete here. But they're called CAPTAP fees in reference to the Computer Assisted Property Tax Administration Program of old. We would love to get this removed from the statute now because we do have a very fancy new system, VTPI, that you heard Jill talking about this morning. It is absolutely free. Municipalities will be using it a lot. And we have had some folks voice confusion about seeing this language in the statute about fee charge to municipalities and just, wanting to clarify that that wasn't for our new system. And yeah, we just want to make that crystal clear by removing it completely. Kind of sticking on the PBR track, the next proposal, number 7. This is just an update to modernize some statutory language around current use enrollment notifications. The statute has a lot of mentions of certified mail and just mailing things in general. And so the changes are getting rid of certified mail in all cases and also just like opening up the communication channels. Like there's some language like notification needs to be sent to the person's like last known place of abode, which, if that's in statute, that's where the mail has to go. But it could be that we're like on the phone with the person and their, their timeshare in Florida or something. So just, making it easier for folks to get have the communication they need to be having with PBR to get their current use pieces in order. And then, we did check this with other departments, and it seems like certified mail has really been phased out of a lot of folks' operation just because of how hard it is for folks to get. It's not what it once was. So that's the sum of those changes there. We're also recommending some technical corrections to our reappraisal statutes, hot topic this year, but these are all pretty minor. The first change would basically align our statute with the current administrative rules that require towns to use a qualified appraiser to conduct a town-wide reappraisal. Currently, the statute just talks about a qualified appraiser conducting individual reappraisals. And we just want to make sure that this is like the training program Jill was talking about this morning, completely free, offered online and in person, just making sure that folks doing a town-wide reappraisal have that same requirement to undergo that training. And the second change is just to reflect the PBR's current practice of providing an interim CLA to towns after any level of reappraisal. I think right now in statute, it talks about providing an interim CLA after like a capital R townwide reappraisal, but there's, interim steps that communities might do, like I'm just focusing on commercial properties or a statistical reappraisal, which I'm not actually sure what that is. So we'd have to ask Jill to come back in to explain that. But just making sure it's current practice to have those updates reflected in a town CLA and making sure that that's clarified in statute too. Is there?
We have a.
Excuse me, yeah, and this may be a Jill question, but I thought because the CLA is a moving average, that you wouldn't necessarily want, just because there's a reappraisal, to chuck the, I think it was a 3-year melded,
It's a 3-year average.
yeah, 3-year average. Or is that your intent, the intent of that language is forget about the past, it's what, in fact, the work product of that year, period. And I guess just to be clear in that this is not an average figure. This is a instruction to incorporate the most recent reappraisal work product. Forget the history.
I think
Maybe
I
it's clear
understand.
to those folks who are.
No, I think I understand your question, and I'm also have self-awareness to know when I've reached the limit of my understanding of something. So I think that's, yeah.
We don't want people to average. We want them to institute the new figure standalone.
I'm just going to get
Be real clear that
Yeah.
that's what the language will achieve, because I think that's what you want.
I'm going to get a clearer write-up or have her come back and visit on this particular technical provision, because I don't want to say anything incorrect and then have that be what sticks in all of our minds. So, yeah.
We have the statutory language in front of us. We can have her.
Great. Perfect. That would be awesome. And I'll give her a heads up about that. Okay, we're ending on more exciting stuff. This is good. Almost as if I planned it this way. So the next one I think is really cool, actually. We are proposing a property transfer tax exemption for controlling interest style property transfers that occur if a nonprofit is undergoing a major reorganization in a hypothetical situation. Some context here is that a couple of years ago, the legislature extended the property transfer tax beyond just like deeded property transfers to include controlling interest transfers when a entity transfers from one owner to the other. This happens like formerly if a corporation bought another one and there was real property involved, if it wasn't like a real deeded property transfer, the tax wouldn't touch that, wouldn't apply in that case. So the legislature, created this new class of controlling interest transfers, and at the same time made a exemption for C corporations that were simply undergoing a reorganization. Like there's no change to the beneficial owner, just like a lot of moving pieces. They didn't want it inadvertently triggering a property transfer tax if it was really, just a reorg. But it has come to our attention that as written, this language couldn't apply to the exact same situation that a nonprofit was undergoing, because the language specifically references owners and there's no ownership in the same way in a nonprofit situation. So the recommendation in the proposed language was just to create a complementary exemption for a nonprofit in the same situation. This was brought to our attention from stakeholders, but we don't have any examples of this actually occurring. So this is again proposing this as a technical correction with no revenue impact, because we don't see this as being a real common situation for nonprofits. But want to make sure they have the same flexibility that a C Corp would. Great, awesome. Two more. Okay, number 10 is what you heard from Commissioner Bolio about last week, which is our proposal around how to handle local option tax revenue that was erroneously collected in a jurisdiction that's not authorized to collect a local option tax. So as Craig described, as Commissioner Bolio described, in that situation, if the commissioner determined that the transaction occurred in a district that wasn't authorized to collect a local option tax and one was erroneously collected, the state would retain that fund so they could either refund the impacted customers, and anything that wasn't refunded would then just be deposited into the ed fund or general fund, respectively, depending on whether it was sales and use tax or meals and rooms tax related local option tax.
Yeah.
This presumes, though, that the proceeds have not already been distributed to the towns. Otherwise, there's a clawback, or do you not cover
Right.
that problem or issue.
Well, this definitely presumes that this is like something that we've been alerted
In-house
to, that we
before.
could see. Yes, exactly. We do, like, for example, if one local option tax town, is if a business inadvertently collects for one local option tax town, but the business is really like in a different local option tax town, we have, processes to easily
Okay.
redirect that money. So and that's, it's not the same issue because.
It
that
still
town-
offers you the flexibility to, in case, make people whole.
Yes, exactly, exactly.
Finish your sentence.
Yeah. So like if a community is authorized to collect, then the infrastructure is there for us to like be shuttling money back and forth. And, refunding does happen now, even outside of the context of, a business collecting for a municipality that's not authorized to collect. But it's just like having well-worn territory when we have, the financial arrangements with two local option towns that are both authorized, and it just needs to be corrected that way. So this is kind of like the unexplored territory that's reared its head in the recent local option tax towns that have come online is a situation where a town that has not been authorized by the legislature or their own charter to collect a local option tax, a business in that town is doing it, then we don't have that same, like easy tools to be shuttling funds back and forth. And also it's kind of unclear in statute who should be getting that money, if not the person who it was erroneously collected from. Yeah, great. Okay. The last one, this is kind of cool also, I think, from a tax nerd perspective. So in designing the forms this year, it became clear that like we have a pretty like wild environment of our now like 3 very potent refundable tax credits. So and this is it gets a little wild for folks who are part-year residents, which is like often referring to folks who are filing in Vermont for the first time, like they've just moved into Vermont for out of state or just started earning in Vermont from earning in a different state, or the year they're leaving Vermont, kind of same style. Each of our 3 refundable tax credits kind of has a unique treatment for folks in this part-year situation. I made a little, I lifted a little table from an email that Jake Feldman sent me, I should say, and cleaned it up here. So hopefully this helps clarify. Our proposal would be to apply the child tax credit, the new credit from last year, apply that scaling strategy to all 3 of our refundable tax credits. Because currently each one has their own unique treatment. And this is, this can be just like a confusing situation for taxpayers to navigate, especially if you're a part-year resident who's, just in your first year of moving to Vermont, like could be, your first time dealing with the tax code and if you're, someone who can benefit from these credits, sometimes, like confusion and complexity could be a barrier to accessing some of these benefits. So the idea of streamlining this for folks who are eligible for the credits is really appealing for us and will also make our forms nicer. So basically, child tax credit, very straightforward. Your credit amount is scaled based on a ratio of your Vermont income to your everywhere else income. So if you made 75% of your income in Vermont, then you'll get 75% of your child tax credit. The EITC is really similar, but the statute language is a little different. It refers to specifically earned income and then defines that a little differently. And then we have like a whole kind of like sub portion of a form that's about finding that ratio. And when we did the exercise of looking at all the EITC recipients, if those definitions had been changed to just the general income definition, where we saw an average of less than $4 change for each person, and like year to year would either be like up a couple $1,000s or down a couple $1,000s overall. So that would be a de minimis revenue impact at both the individual level and in a system-wide level, switching that to the same mechanism as the child tax credit. And then the child and dependent care credit is pretty interesting because as written currently, it's only available to full-year residents. So a part-year resident isn't eligible for the credit, like in the year they move into Vermont, for example. But the credit itself is for in-state care expenses only. So it's kind of like it scales itself in a different way. It's like only your Vermont child care expenses are eligible for the credit, but it doesn't ask you to scale your income in the way the others do to kind of like demonstrate how much Vermont you were that year. So by getting this aligned on that same scaling strategy, we could say all care expenses are eligible and instead have it scaled based on how much of their income was earned in Vermont, like the other two. And our analysis, like look into this, show that was anticipates that would be a wash for these folks that might be in that situation.
I have a few questions. One, I think it would be helpful to have a fourth line on your table that is how we just treat apportionment for income.
All income apportionment.
Yes.
Yeah, and I can speak to that really quickly. So just like overall income apportionment is much like the child tax credit strategy is we have a form, the I-113, that kind of like rebuilds your income as Vermont as a ratio of everywhere income, and that ratio is what you can use like directly in your CTC calculation. Like 80% of my income was Vermont this year. Like imagine I just moved from New York, had a little bit of my paycheck from New York, and then, the rest of it was earned in Vermont. So that's kind of how that form plays out. That percentage gets applied to your tax bill as well. Like your Vermont tax bill is constructed as if 100% of your income and livelihood was all here in Vermont. And then it's called the apportionment percentage that gets applied to the tax bill at the end. And that's before your refundable credits.
And I guess I'm just thinking, the logic of having them all be sort of apportionment be defined the same way in all cases.
Yes, and that is
helpful.
Yeah, that was a really good point. That is the child tax credit, much like the income tax system overall, is just like a holistic ratio of Vermont income over everywhere income.
And then I think we're going to have a few more child tax credit technical-ish changes. So I don't know if it makes sense to put those in here or pull this piece out and put those with those. You don't have to answer now. It's just something to think about as we're sort of crafting legislation, if you all have a preference, which we might or might not take. And then in the context of these refundable tax credits, if you've given any thought to ways that we can, through the forms or attached to the forms, or the use of the forms, make sure that more Vermonters are accessing them.
Yeah, great question. So, first, I'll respond to your first question first, which is the child tax credit is actually the one that we don't want to change at all. We think that that's great apportionment language that we'd like to make a slight amendment to the EITC language and the child dependent care language, which is the language you'll see. That's the draft language you'll see, but child tax credit will be left alone. So no additional changes to child tax credit requested from the tax department, just using it to inspire our treatment of the other credits. I overheard the conversation with our taxpayer advocate and thought that was really interesting. I think that, partnering with organizations that like Legal Aid who have, great contact with these constituencies is a great thing for us to be exploring. I'm not sure if Jeff Dooley mentioned this, but I know that a lot of times we're a little hamstrung in the language we can use because, being the tax department, everything has to be really legally accurate, in case someone makes a tax decision based on it. And then, we're in would hate to think of, a casual wording on our point leading to some situation that leads to an appeal and there's litigation regarding it and, things like that. So that's not something I have a lot of experience navigating, but can definitely see the complexity of the plain language communication of these things. And that's why I just appreciate having partners that are really well-versed in these supports, who can don't know, do more of that. But I definitely, great area to explore.
Representative Sims, Representative Beck.
Yeah.
Thank you for this, and certainly love the idea of simplifying and alignment. I just want to make sure that I'm fully understanding the proposal around the dependent credit. And I think I'm hearing that the proposal is I would aggregate my total child dependent care costs in a year, and I would multiply that by the percentage of my income that was in Vermont, and I would receive the tax credit based on applying my percent Vermont as determined by income to my annual child dependent care costs.
Yeah, with that's totally spot on. But it's even a little simpler than that because this is a percentage of a federal credit. And currently, if not all of your care expenses are in Vermont, you'd kind of have to recalculate your federal credit just considering the Vermont only expenses if you're going to comply with current law, which says in-state care expenses only. So this would further remove a barrier of complexity by just saying, whatever your federal credit is, even if, this tax year is the year that you moved from New York to Vermont and some of those care expenses were in New York, that you used, some of the care expenses that you used to calculate your federal credit might not have been in Vermont, but that would be okay now. We would say, we're going to give you 72% of the federal credit, and then we're going to scale that amount based on the share of your Vermont income to your everywhere income.
Does that link up how most other states do it, or do they have more of this in-state expense approach, so that, I'm not meaning to imply intent, but that I might receive a benefit of expenses that I had when I lived in Massachusetts, and then I was also on my Massachusetts return receiving a tax credit for those same expenses in Massachusetts.
Right. And it's an excellent question. I do want to follow up with you about that because I don't remember the answer for how others states' treatment of the child dependent care credit works today and how aligned that would be. But the apportionment for the part year residents is meant to address exactly that situation. Because even if you're, Massachusetts childcare was part of that 72% federal credit, we'd then be scaling it to, how much of your time was spent in Vermont. And with the assumption that when you moved in Vermont, maybe your care expenses moved from one state to another and maybe your income did as well, so it's like that you spent 70% of the year in Vermont. And so now your credit's getting apportioned down to 70% that way. Whereas, under current law, you might spend 70% of your year in Vermont, or you might have 70% of your care expenses in Vermont and kind of the credit scaled that way. Sorry, that was kind of.
I guess I'm having trouble understanding the complexity of just doing myself an example. My child care provider provides me an annual statement of my in-state expenses, and it's very easy to translate that right onto the tax form. So I guess I'm having trouble understanding the problem we're trying to solve there if we're crediting people for expenses in the state that they actually have on their tax return.
Okay, let me try it. So let's say someone spent split the year between two places, had childcare in two places. They're going to go through, when they're doing their taxes, they're going to be articulating those expenses to claim a federal credit. And all that work is going to be done for their federal return. And then when they get to their Vermont return, they just pull under the proposed language, they would just pull that amount from the federal return, all the work that had been done, which it is actually a pretty complex credit too. It's capped at either your tax liability or your earned wages or your spouse's earned wages. There's a lot of nuance for this federal calculation. I've never claimed it, but just looking at the form, it looks
Also, on tax ID numbers for every provider, it's something of a nightmare if there's a lot of summer camps. Anyway.
Yeah, okay. So all this work's done to calculate the federal credit. But today, this year, if your federal credit was calculated on the whole universe of your multi-state life, Vermont would ask you to go back in and kind of calculate a pro forma as if it was just Vermont. Like all those other complexities still need to be applied, like capping it at your income or your spouse's income, if that's the structure of your family, or capping it at your federal tax liability. Like all that, like the machinations of creating the federal tax still has to occur, but you kind of have to redo it as if all your care happened in Vermont. So that feels like, if we could have the same apportionment happening, like in an easier, more streamlined way, like the same way it does for apportioning the rest of your income and your EITC and child tax credit, then that feels like a win for a taxpayer experience, perspective. Like you're not having to go recalculate like the federal base, just it's like, yeah, I know some of those care expenses happened out of state, but luckily my credit's getting scaled this other straightforward way, and I don't have to go back and do like a pro forma calculation.
Am I right in understanding that this would only change the experience of someone who is living in multiple states?
Yeah,
My lesson, don't ever move.
yeah,
Yeah, already that's it.
yeah.
Representative Beck and then Representative Anthony, and then I think we need to wrap
Just
up.
to make sure I understand this. So in this, it wouldn't matter where income was earned and which state income was earned. And it wouldn't matter where childcare services were delivered. The only thing that matters is how much time you lived in Vermont.
It's your time in Vermont, but as articulated by where your income is earned. So it's like the ratio is Vermont income to everywhere else income. So we are agnostic about where the everywhere else is, but for either an individual's tax return or a joint filer's tax return, that's if you have income from places outside of Vermont, then you'll have this apportionment schedule that applies that ratio to your tax bill overall, and then also to these refundable credits that come
So
after.
but if somebody, lives in Vermont, works in New Hampshire, all their income comes from New Hampshire,
Mm-hmm.
would they not be eligible for any of these state tax credits?
So these credits are currently available to part-year residents, or I guess if someone had absolutely no Vermont
Yeah.
income, they might be filing a non-resident return. Actually, I don't want to say that.
Yeah,
There might be some
Vermont
domicile issues that I'm not thinking about. If you have like your homestead here, but none of your income's earned
Vermont
here.
resident drives to New Hampshire and works every day.
Yeah. I just don't want to speak to the residency, where they fall in that definition, because I'm not sure about that. But they would be apportioning all that income to New Hampshire, and their Vermont, their Vermont tax bill would be dramatically reduced if only a very small share of their income came from Vermont or none. But sorry, to get to your original question, EITC and child tax credit are available to folks in this situation, but just would also be dramatically scaled down if they only are making a little bit of income here and
Even if they're
more
making no
income.
income, they'd get no credit.
But it's a refundable credit.
Nope.
It wouldn't be because of no tax liability. It would be because of the ratio. These extremes are interesting. I could bring some examples. Yeah.
Scott and I are often in the border town conversation
Yeah.
together. And so I think it would be really important to understand if someone is, if I have a constituent who's driving across the border to work at Walmart every single day, whether or not they'd be able to get the child tax credit.
I mean, we, in that situation, we would charge that person Vermont state income tax on that income earned outside the state, right? I think.
Well, they would have a calculated income tax bill, but if their apportionment percentage is zero, if they have zero income earned in Vermont, then we will not be taxing their income. We'll apply, they would still be eligible for credits unless they're also scaled down to zero.
You wouldn't charge them Vermont state income tax on income that a Vermont resident earned in another state?
If all the work is performed in the other state, then no.
No, and there's no state.
It's my understanding, yeah.
Okay, I might need to learn more.
Yes.
Encourage them to work remotely from home.
Yeah, then you're good.
I don't think that would work in my Walmart
I was just
example.
gonna say,
So, yeah, I think we might need to spend some more time diving into this.
Yeah, no, totally.
Okay. And then I think Representative Anthony, you had
I'll take a pass. Thanks.
Oh, pass, okay. All right,
do you have any?
lively end.
You wanna? share with us before you?
No, I trust that I will remember all the questions I said I would answer. with The support of my
I don't think you have to.
But thanks so much. Yeah, and absolutely willing to come back or bring Jill back when you guys have language to look at.
Okay.
Thanks again.
Thank you.
Jill. Thank you. Stays here.
Next up, we are going to talk about tips, but before we do that, we're going to take a 5-minute break.